Are you interested by the idea of investing in real estate, but because it seems too complicated, it feels like it's out of reach? You're not alone. Many people find the traditional real estate market daunting due to high initial costs and the complexity of property management. It's easy to feel like you're missing out on a lucrative investment opportunity because of these barriers. But there is a way to invest in real estate without all the hassle of actually dealing with the property itself. This is through the idea of real estate investment trusts, or REITs. They allow you to tap into the real estate market and enjoy its benefits without having to buy or manage properties yourself. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discuss is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. In this video, we'll talk about the benefits and risks of REITs to help you understand if they might be a good fit for your investment goals. So sit back and keep watching to discover how REITs can make real estate investing simple and accessible. What are REITs? REITs are companies that own, manage, or finance real estate properties. Instead of buying properties yourself, you can buy shares in a REIT, which then invests in a variety of real estate assets such as office buildings, shopping centres, or apartment complexes. There are three main types of REITs. Equity REITs own and operate income-producing property and make money from rent. Mortgage REITs lend money to property owners or invest in the property mortgages, earning money from the interest on these loans. Hybrid REITs combine aspects of both equity and mortgage REITs, owning properties and investing in mortgages. How to invest in REITs? Investing in REITs can be done in a few different ways. You can buy shares of individual REITs through a brokerage account, allowing you to select specific REITs based on their focus and performance. Alternatively, you can invest in REIT mutual funds or exchange-traded funds, ETFs, that hold shares in multiple REITs, providing broader exposure and diversification. If you're looking for a broker that lets you buy REITs without charging exorbitant fees to do so, then let me introduce you to Trading 212. I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. So if you've opened a new account recently or are planning to open an account, then here it is. DivXP, or DIVEXP, short for the Dividend Experiment. So you have 10 days from opening your account, type this in, and receive shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, thank you for your support, and thanks to Trading 212 for sponsoring this video. Benefits of investing in REITs. Investing in real estate investment trusts offers several advantages that can make them an appealing option to many investors. One of the primary benefits is the regular income that REITs provide, as they are required by law to distribute 90% of their taxable income to shareholders as dividends. This makes them a reliable source of income, often yielding more than other dividend-paying stocks. REITs also offer diversification by giving investors exposure to the real estate market without the need to directly buy or manage properties. This diversification can help reduce overall investment risk. REITs invest in various types of real estate, from residential and commercial properties to specialized assets like healthcare facilities and data centers, further spreading risk across different sectors. Liquidity is another key advantage of REITs, as most are publicly traded on major stock exchanges. This means they can be easily bought and sold, providing a level of liquidity that direct real estate investments can't match. REITs also make the real estate market more accessible to individual investors, requiring less capital and offering flexibility that traditional property ownership doesn't. In addition to income, REITs provide the potential for capital appreciation. The properties they own can increase in value over time, potentially boosting the share price and offering capital gains alongside dividend income. This makes REITs a good option for investors looking for both income and growth. REITs can also serve as an inflation hedge, as real estate values and rental income often rise with inflation. This helps protect against the loss of purchasing power that inflation can cause. Furthermore, because REITs pass most of their income directly to shareholders, they avoid corporate income tax, which can be beneficial for investors. However, it's important to note that dividends from REITs are typically taxed as ordinary income. Professional management is another benefit, as REITs are managed by experts who can specialize in real estate investment and property management. This professional oversight can lead to better decision making and efficiency compared to managing properties on your own. Moreover, on top of that, REITs offer transparency and regulation that provide investors with confidence. They're subject to regulations that ensure regular financial reporting, helping investors make informed decisions. This, combined with the variety of REITs available, such as equity REITs, owning properties, mortgage REITs, investing in property loans, and hybrid REITs, combining both, allow investors to choose options that best align with their financial goals and risk tolerance. Finally, the lower entry cost of REITs makes them accessible to a wide range of investors, including those who might not have the capital to buy real estate directly. This affordability, combined with other benefits, makes REITs a versatile and attractive investment option for those looking to gain exposure to the real estate market. What to look out for when choosing REITs? When choosing REITs, it's essential to evaluate several key factors to make an informed investment decision. One of the first things to consider is the dividend yield, which indicates the income you can expect from the REIT's dividends relative to its share price. A higher dividend yield often signals a more attractive income stream, but it's important to balance this against the risk level of the REIT. Another critical factor is funds from operations, or FFO, a metric that shows how well the REIT is performing in its core real estate operations. FFO adjusts net income by adding back depreciation and amortization, which are non-cash expenses, providing a clearer picture of the REIT's operational efficiency and profitability. A strong FFO suggests the REIT is generating solid cash flow from its properties, which is crucial for sustaining and growing dividend payments. Net asset value, or NAV, or sometimes called just NAV, is also a significant measure to consider. NAV represents the value of the REIT's properties after subtracting any outstanding debts. By comparing the REIT's share price to its NAV, net asset value, you can gauge whether the REIT is trading at a premium or a discount to the actual value of its assets that it holds. This helps in assessing the REIT's market valuation and whether it's fairly priced. The debt-to-equity ratio is another important indicator of a REIT's financial stability. This ratio compares the amount of debt the REIT carries to its equity, revealing how much leverage it uses to finance its operations. A lower debt-to-equity ratio typically indicates a more financially stable REIT, with less reliance on borrowing. However, some level of debt is common in real estate investments as it can enhance returns, so the key is finding a balance that aligns with your risk tolerance. By carefully analysing these factors, dividend yield, FFO, NAV or NAV, and the debt-to-equity ratio, you can better understand a REIT's performance, value and financial health, helping you make more informed investment choices. Risks and considerations. However, REITs do come with their own set of risks. One major risk is market risk. The value of REIT shares can go up or down based on overall market conditions. If the market is struggling, REIT shares might drop in value. Additionally, REITs are sensitive to changes in interest rates, so when interest rates rise, borrowing costs for REITs increase, which can hurt their profits, especially for mortgage REITs. Some REITs also have high management fees, which can reduce your investment returns. The performance of a REIT depends on the properties it owns, so if those properties face issues like vacancies or declining rents, it can affect their REIT's performance. When choosing a REIT, you have to look at their list of tenants, as those will ultimately be the ones paying your dividends. Real-world examples. For some examples of REITs, as well as to demonstrate the variety of different types of REIT you can invest in, we will look at some well-known REITs, including Prologus, and industrial REITs, specializing in logistics and distribution centers. Realty Income, a commercial REIT focused on retail and commercial properties. Vici Properties, a gaming REIT that owns casinos and entertainment venues. And Digital Realty, a data REIT that provides data center solutions critical for digital infrastructure. Prologus, industrial REIT. Prologus is one of the world's largest industrial REITs focusing on logistics and distribution centers, and these facilities are essential for global supply chains, serving companies that need to store and distribute goods efficiently. Prologus operates in key markets around the world, strategically placing its properties near major transportation hubs. Why it's important? As e-commerce continues to grow, so does the demand for warehousing and distribution facilities. Prologus benefits from this trend as more businesses require state-of-the-art logistics solutions to manage inventory and ensure fast delivery times. Realty Income, commercial REIT. Realty Income is a commercial REIT known for its focus on retail and commercial properties, and what sets Realty Income apart is its monthly dividend company trademark, reflecting its commitment to pay consistent monthly dividends. The company's portfolio includes properties leased to well-known tenants like convenience stores, drugstores, and supermarkets. Why it's important. Investors are drawn to Realty Income for its reliable income stream, underpinned by long-term leases with creditworthy tenants. The stability of its cash flow makes it an attractive option for income-focused investors. Vici Properties, a gaming REIT. Vici Properties is a gaming REIT that owns and leases properties primarily in the entertainment and gaming sectors. Its portfolio includes some of the most iconic casino resorts in the United States, including properties on the Las Vegas Strip. Vici earns revenue by leasing these properties to operators like Caesars Entertainment. Why is it important? Vici Properties offers exposure to the gaming industry, which can be lucrative due to the consistent demand for entertainment and tourism. The company's focus on high-quality assets in prime locations helps it maintain strong occupancy rates and generate stable income. Digital Realty Data REIT. Digital Realty is a leading data REIT that specializes in owning, acquiring, and managing data centers. These facilities are crucial for the operation of digital services, cloud computing, and the internet. Digital Realty's properties are located in key metropolitan areas across the globe, serving a diverse range of customers, from tech giants to financial institutions. In an increasingly digital world, the demand for data storage and processing power is surging. Digital Realty is well positioned to benefit from the growing need for data centers, making it an attractive investment for those looking to tap into the tech-driven economy. Now, I'm not recommending that you buy any of these REITs specifically, they're just examples to start off your research. I'm also contemplating making a REIT-based pie on Trading 212, but would really depend on how widely supported it would be. We'll just have to see. In conclusion, REITs offer a way to invest in real estate without buying property directly. They provide benefits like steady income, diversification, and liquidity, but also come with risks such as market fluctuations and interest rate sensitivity. Understanding these aspects will help you decide if REITs are right for you. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!